Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Blikre, your host, and with me is my co-host, Yahoo Finance senior reporter Brooke DiPalma, who's here to connect the dots and to be that bridge between Wall Street and Main Street. Today, we're going to be talking about market technicals, reading the tea leaves and charts and market data, and we've got one of the best in the biz as our guest today. Our word of the day is defense, the kind you use to protect your portfolio, not your country. Why defensive stocks are surging and what that means for this 4-year bull market. And on today's Market Show and Tell, we are looking at the recent breakout in large cap energy from a 20-year base. The longer the base, the higher in space goes the saying, so we're going to tell you the ETFs that might be your rocket ship. And this episode is brought to you by the number 42%. That's how much Bitcoin has sold off from its record highs recently, how it's tied to the sell-offs in gold, silver, and the strength in the dollar. And today we are welcoming back Mark Newton, who is a veteran technical strategist at Tom Lee's Fundstrat with decades of experience across both the buy side and the sell side. He has held seats at places like Morgan Stanley and Diamondback Capital, and earlier in his career traded equity options on the SIBO. I followed his work for well over a decade, and I can verify he is both meticulous and prescient when it comes to the craft of technical analysis. So it is great to have you back here, Mark.
Thank you, Jared. Hi,
and it has been a while since we've seen you. What do you think of the markets right now?
Oh, boy.
Well, investors really have to come to grips with the fact that we're seeing just a massive amount of sector rotation these days, along with really an uptick in cross-asset volatility. I think it's a very different market than people are accustomed to. Normally in recent years, we've just been used to seeing technology go straight up day after day and week after week. And there's been a definite bifurcation within technology where a lot of the software stocks have been really hard hit. And meanwhile, most of the Mag 7 have now turned into Lag 7, and they're doing far less, they're making far less robust, returns than I think we've seen in recent years. So, stocks like NVIDIA and Microsoft, and they've all been going sideways, if not down, since last July, August. So investors really have to get used to the fact that, these are necessarily not the areas of strength where they want to be focusing these days. And that very well could be the theme for 2026. To your point, sometimes defense is a good offense.
And let's break that all down because that is our word of the day. That is defense. And no, we don't mean defense contractors. We mean the way investors start playing defense when the market still looks okay, but they don't fully trust the weather. Defense is when money shifts towards steadier corners of the market like healthcare, utilities, or consumer staples, the type of stocks that tend to hold up better when the market is sliding and investors get a bit nervous. It's caution, not panic. And if you see defense show up while the indexes are still hanging in, that could be a quiet tell that risk appetite is cooling even if prices aren't. So Mark, tell us about some of the defensive signs that you're seeing. And is this a blip in the bull market, or are we going to keep going from here?
Yeah, a couple good questions. I think last year was the year we finally started to see utilities and healthcare really start to perk up. That was the first signs. I would argue those really weren't the signs of a real defensive market, that it's really just started in the last month. Really with the move in consumer staples back to new all-time highs. We've seen that not only on a cap-weighted, but also on an equal-weighted basis. And just to give your listeners some perspective, I always look at an equal-weighted basis. I think it's important to strip out some of these heavy names that dominate the indices and ETFs to really give yourself a fair picture as to what the indices are doing. Yeah. So when we saw an equal-weighted move to new highs literally in the last couple of weeks in consumer staples, looking at like RSPS for the Invesco's ETF, that was an interesting sign. Seeing Coca-Cola, McDonald's move to highs. Nobody talks about these stocks anymore. Right. It's all about what is Palantir doing, what is NVIDIA doing, and Apple.
Palantir's not doing that well. Just broke ahead and shoulders.
That was part of it. And then we saw, honestly, the telecom sector start to come back to life. That's also a very defensive area with AT&T and Verizon, these dividend-rich type stocks that really don't hardly move all that much during bull markets, and all of a sudden when they come back to life, it means it's time to pay attention.
So are people trying to just play it safe in this environment?
Well, it's less about what people want. Sometimes these moves, happen when people aren't, all getting together at the lows and saying, let's buy staples. If anything, they're still concentrating on tech. The majority of people I speak to are still hugely overexposed to technology, whether they want to be or not, through the QQQ or through S&P. when these ETFs own just a tremendous.
There's not a lot of diversification in the market cap.
Yeah.
That's exactly right. And so I've been, sort of preaching to our own clientele that maybe it's time to own RSP versus SPY. And that way you get an equal-weighted basket of things that are exposed to financials, utilities, areas within industrials like the home bill, in general, many different parts of transportation that are all of a sudden hitting new all-time highs that investors aren't paying attention to. And these have been really strong areas of the market in recent months, whereas tech has started to flounder a bit. So it's proper to really pay attention to the sector rotation. That's first and foremost.
So let's stick on tech for a second there. The software industry has just kind of tanked over the last month, and it just doesn't look that great on the chart.
Yep.
Chip stocks were holding up well. I was looking at year to date in my chip heat map the other day on the Wi-Fi Interactive. NVIDIA was negative for the year, but a lot of these other companies like Western Digital, SanDisk, they're keeping hope alive. But then over the last couple of days, chips have been catching down to software. You think this is just kind of temporary behavior, or are chips kind of losing favor too?
Well, it's early to say that semiconductor stocks are turning down, but I think we're really on the verge, and that should happen within a month. I think you really have to be a lot more selective with what you own in the space. We saw it initially, to your point, software started actually right around the time the market bottomed in April of last year. That's when software versus semis really started to deteriorate, and really versus the broader tech space. And
we saw names like Salesforce.
those have been under pressure for
Adobe.
some time. Adobe, Oracle, obviously had been hit very hard, and then Microsoft, which was just a shock to many people, hitting multi-month lows. But what I saw, which I found fascinating, was IGV, the software ETF, versus the equal-weighted tech index broke down below a 15-year area of support, which is shocking. And that means what people say about these software companies being left behind through AI, very well, it's starting to be realized. We're seeing signs of that. Maybe they're not recouping as much of their investment as they want to just yet in the AI, bull market. So, look, I don't expect a bear market to last for years, but my 2026 outlook did call for 15 to 20% correction in the market this year, which I think is starting to show evidence of, we're seeing definite warning signs approaching, and defense is certainly part of that. When we start to see trends being broken, I think that happens in March. We head down sharply into May. We might have a summer bounce and then a third quarter correction. I think the market likely will bottom out by October, and we'll commence with the bull AI spend and whatever you want to call it, the big bull market. So, these tech companies just need a reset. It's not like they're going away. They've all changed our lives for the better. That continues to work. But I sense that it's not going to be straight up after 2 straight years of 20-plus returns, 17% last year. This year is visibly different. Meanwhile, sentiment is getting more and more optimistic, which is unusual, just given what's happening around the world with the uptick in geopolitical tension and the divisiveness and everything we're seeing. It's crazy. But the attitude towards stocks has actually gotten more aggressively bullish in the last couple months, and something I'm definitely watching as breadth starts to gradually wane.
A little detour here, but we're going to keep it on defense because on today's Market Show and Tell, we're focusing on the recent breakout in the energy sector, particularly the big oil and gas companies that are represented in the large cap SPDR Energy ETF XLE. It recently broke out of what is arguably a 2-decade-long trading range, finally breaking through its upper end, which we call resistance. In markets, resistance is that ceiling that a stock or a sector keeps bumping its head against, a price area where it's struggled to push higher in the past. The opposite, by the way, is support, or the floor, where buyers tend to step in and keep it from falling further. But Mark, I've been watching this XLE setup for years, and it's finally happened. And how do you want to play this, and how does this fit into your bigger picture of the markets kind of having a little stumble this year?
I came into 2026, and actually energy was a group that I suggested being overweighted for the first time in about 3 years. So it does look like crude oil is ending its 3-year bear market and should start to turn higher. One can point to, Iranian tension being potentially one catalyst for why crude oil is moving up in the near term. But, oil is incredibly cheap, I think, by a lot of metrics. I think, part of me, thought that maybe the administration had cut a deal with the Saudis to keep prices artificially low to punish Russia and punish different, areas of the world that weren't producing. But I sense now that the demand seems to be coming back, at least from areas like China. I think that's important. It's all about supply demand. And initially, I sense that we get to the high 60s in crude. I think we probably back off into March, and I would use that as a chance to buy. I think this is the first, important move off the lows, which started, about a month ago. And to your point, XLE has been doing very, very well. A lot of that's, the integrated companies, ones that are a little bit more of a safe trade to the defensive theme. So the Exxons and the Chevrons of the world, they have a lot of cash. They're some of the world's biggest energy companies. They normally tend to outperform when the markets are a little jittery. What I want to see is things like XOP start to come to life, the exploration and production ETF, as well as OIH, which OIH has done quite well along with XLE.
Servicers, yeah.
So I think it's going to be a great place to position. And I think, investors can look to take money out of technology and consider some energy exposure for the first time in years.
Now, at the same time, though, we started this year with this geopolitical tension really gaining fear within investors' minds. And now they're kind of hearing you kind of get into a sector that has exposure to geopolitical tension.
Right.
So how should they be thinking about that and sort of push away that fear?
One should never use external events at all to be afraid of anything.
Turn down the news.
If you use technical analysis, then you help to put you put a blindfold on to what's happening around you. Unfortunately, as important as those events are, and concentrate on sector rotation. You concentrate on what's moving. And this year for investors, amazingly, even though signs of inflation are going down, we're seeing commodities really start to perk up and do well. And that's being reflected in not only the material sector, but also energy doing well this year. So, I think it's an interesting, probably a 6-month trade initially where, the prices of materials and energy both start to do very, very well. And I think we'll get some rotation probably into other areas after that.
And you said, wait a bit, look at March for the timing of that.
Well, I think between now and the end of the month, I sense that from my read on what's going on in the Middle East, we could start to see further tension, which means that oil likely is still going to go higher in the near term. So both from a trading perspective and also probably a longer term perspective, energy makes sense. I worry about the time between, I guess, late February and probably May. I think we'll probably get a decent pullback in many sectors then. Yeah. So I would use that as a chance to buy energy. As we know, seasonally speaking, the first half of the year is almost always the time when you want to be long energy, long crude oil. The back end of the year tends to disappoint. So we're sort of in the sweet spot now. Tech is not working as well. Energy is. It's a pretty clear signal to me that you at least have to have some exposure in energy.
Lots of good tips there, but we do need to take a quick short break. Coming up, we're talking about the sell-off in Bitcoin and the meme stock-like trade for gold and silver. Stay tuned. This episode is brought to you by number 42%. That's how much Bitcoin has sold off from its all-time high of just over $125,000 that it hit in October of just last year. This week's low is just around 73,000, but that's close to being taken out in this very moment. And it's not just crypto. We just watched gold and silver whipsaw violently too. A rare week where safe havens and risk assets both felt like pretty much roller coasters. Mark, the action that we've seen in metals and crypto and dollar and interest rates, I mean, they have been fast and furious. So how are you thinking about all of this right now?
And you said cross-asset volatility. Maybe break that down for us, too.
I'm thinking carefully about all of it.
I know.
Look,
metals,
I think we've
crypto.
seen huge sell-offs. One of the biggest sell-offs of all time in gold and silver on a 3-day basis. Mm-hmm. I think that the metals trade is viable for the next month, but I don't sense we get back to highs. I sense that a lot of damage has been done very, very quickly. Momentum has started to roll over. So I sense after a bounce that the metals probably go back to the lows. Cryptocurrencies are in a very difficult spot right now. And I do believe we're in a crypto winter, a 4-year cycle, which tends to repeat. I don't sense that we're going to go down 80%. Personally, I think it's going to be capped at I think Bitcoin, in my own view, goes to 60, between probably
60.
high 50s, 60. I don't think it's going to be a straight shot. So
frustrating, too.
Really,
right? That's what it does.
You have to be prepared to really hold this. And many people, even that use technicals, get caught off guard with the sudden volatility. And you're like, wow, well, I guess I'm a hodler now. I have to stay in, right? I can't get rid of it now. But look, it's difficult. My thinking is a short-term bounce could happen to 87, 88, and then we go to 60 probably into May, and that's the time you want to have some powder dry. So crypto, it's not the end of the world. I think it will bottom probably sooner than it has in years past. Crypto will likely bottom before equities, so equities could have a larger drawdown in Q3, whereas I think crypto very well might bottom out sometime in the spring and start to turn up again. So I have optimism, but it's really important to be patient. Don't put all your assets in one basket and diversify. Understand that we're in a very strong bear market right now, and even if we get a bounce, the path of least resistance right now remains to the downside, at least with regards to crypto. With metals, eventually I think we'll probably get back to the highs.
Eventually, though. You talked about taking out recent lows after this.
Yeah, that's right. So you bounce probably throughout February in both gold, silver, and then I think we turn down, and I think we probably take out lows, which means it could get worse. Gold might get to 3,700, 3,500. And then I sense
brutal, Jared.
we probably summer into the fall is normally a great time for the metals. The key message for the metals is that still all the pieces are in place why you still want to own metals, and that being the Fed still has potentially a lack of independence right now, even under Warsh. We just don't know what's going to happen. We don't know his communication style.
Yeah.
And obviously, when you look back over history, a change in Fed leadership is generally not a smooth time for markets. It happened initially under Powell. You saw it under Yellen. You saw it at Bernanke. You saw it under Greenspan after 87. The normal max drawdown is about 17%. So we have to be prepared. Ironically, the thing the administration wants to do, change Fed leadership, could be the thing that honestly causes volatility that might prove problematic come the elections, and that if the market shows a lot of volatility, that could change at least the House with regards to the leadership. But getting back to crypto and gold, I'm long-term bullish, but I sense the level of spending is a difficult problem on both sides, being not willing to address it. And normally that's good for precious metals, as is cutting rates. All those things are still in place. But the volatility has reared its ugly head and likely means that between now and, let's say, April, May, gold, silver probably drop, and then it's time to get long again. I sense that gold goes to 67.50. Silver probably can go back to new highs, particularly with China demand coming back. I think they're very, very good.
3,700 and then wait for 100%.
These have become.
And when would this happen? Because we're hearing from like J.P. Morgan and others. Their targets for gold are over 6,000 by year end, and you're saying like when would that?
Yeah, I think that's probably a year end. I don't look. These are very extended in their longer term cycles. We've already seen almost a 3-year rise in the metals, and everybody all of a sudden became enamored with the metals, and that happened literally right near the top within a few weeks, where everybody knew the metals were working. That's normally not the time to buy them, right? So
when one of my friends is asking me at home, guys, what do I need to know about gold? I'm like, all right, this is Main Street, Wall Street coming together, and honestly, that's great.
Yeah, it always pays to look when sentiment starts to get frothy. I think we've seen that in crypto, where it's spread to the metals, and software obviously is being hit. Now we're seeing all these, storage stocks and the semis have been red hot, and I sense that's probably the next shoe to drop in the next month. But pay attention, use trends, and diversify. I think defense, that's a key message for this year.
Beautiful. Happens to be our word of the day.
It works
but
out just
a
great.
quick pivot here, because we have got a markets take on a classic Hollywood gab show staple, Who Wore It Better. And today's runway is all about tempo, how you play the trading game, and we've got the momentum cyclist up against the diversified golfer. On the left catwalk, the cyclist. Peak performance mode, this momentum trader hits the spotlight in a skin-tight Aero jersey with ticker symbols down the sleeves. This trader is going all out on 3, maybe 4 high-conviction breakout names. No diversification, no hedges, just max watts into a handful of rocket ships. It's pure speed, pure focus, and if one of those bets blows a tire, you're eating pavement. On the right catwalk, the diversified golfer, sustainable pace, clean polo, tailored slacks, and soft leather gloves. This portfolio has a tool for every situation. Driver for distance, wedge for precision, putter for the finish. Spreads risk across asset classes, sectors, and geographies. Never tries to hit a 300-yard chip shot. Just plays the full course with balance and lives to tee up another 18. So Mark, in this trading environment, who's wearing it better? Is it the Momo cyclist or the diversified golfer?
Well, in the words of the Dalai Lama, Gunga Galunga. Look, I'm all in favor of golf this year, honestly. If you're going to be a cyclist, you have to favor the century ride, not the sprint, because I think that eventually momentum continues to work in all markets and will eventually get back into gear. But this is a year, I think, of consolidation, of defense, that favors those that not only can hit it long off the tee, but can putt well as well. And one wants to really favor, I think, the country club, and hopefully that warm weather will be here before we know it. We hear 6
Fingers
weeks, but
crossed.
we'll know. I think there'll be a time for momentum. This seems to me to be a time of value and not growth. And I think the cyclist is going to take, a second seat behind, those that like to play golf this year.
Just to take a step back, for those of you who maybe are hearing you for the first time, when it came to 2025, what exactly did you think it would end up, and how did it play out for your forecast? 'Cause
Well,
you're making some pretty big calls.
I had a target of 66.50, so we ended up a little bit short, but we did get above that. And so I always think the targets are largely are meaningless. They're they're for the media. I know a lot of sell side analysts have to come up with targets. It's really about what is happening now and how you can use price action to be able to help you not only manage risk but forecast the future, and not necessarily go out 1, 2, 3 years and say, oh look, I was right. So. I've had some good calls. I turned bearish in late 2021, early 2022. I was fortunate to catch a pretty good downdraft into June of that year in October. And myself, along with Tom Lee, have been bulls the last couple of years. But this year we said, you know what? It's time to really consider that we could get that consolidation for reasons such as tech starting to gradually wane. Leadership is changing. We're in a midterm election year. We have a new Fed governor approaching. There are all these reasons why everybody thinks, oh, this is happening in the world. This should lead stocks down, the tariffs, and none of that ever materialized, unfortunately. Look, tariffs, you could argue if they were rolled back, that could be a tricky situation this year. And how do we compensate these countries? It would obviously be great for visibility for earnings growth, but they've really helped to trim the deficit down to like 29 billion, which I think has been a very, very good thing. So always tough to know the right answer. I always love to just tune out the news, focus on sector rotation, what's leading, what's not, and let the market tell us what it's going to do. It's giving us a very loud and clear signal right now that I think the next couple months are going to be pretty volatile.
Mark, under a minute, and you've given us tons of actionable information here. Anything we didn't cover, anything you'd like to say to the viewers in about 30, 45 seconds?
Well, I think it's important, honestly, to tune out a lot of what's going on around the world for those that think that those things really matter. And also just pay attention to the fact that earnings and or economic data rarely lead to meaningful trends in stocks as much as almost 90% of Wall Street thinks they do. You really need to concentrate on cycles, on sentiment, and we had very bearish sentiment last spring. It was very important in terms of why markets could bottom. And recently, we're starting to see the opposite. We're seeing very bullish sentiment. So it makes me a little bit more cautious to think that it's going to be a year where you sell in May and go away and whatever. I think the time this spring into the fall is going to be, volatile, but I don't think it's the end of the world. I think it's going to be opportunity for those that have dry powder and you really want to be buying dips, I think, into the fall. The bull market should persist, I think, and continue up in the years to come. But we need that consolidation, and I think that's going to happen this year in 2026.
All right. A year of defense, just kind of rewinding it back to the beginning there. And we have seen defensive sectors on the rise here, from consumer staples to utilities to real estate to healthcare and even energy. Yes, energy can be defensive as well, especially those big ones that we were talking about. But meanwhile, speaking energy, that's where we're seeing the breakout right now. And as Mark was just telling you, he was very bullish coming into the year, and that's playing out. So we got to pay attention to that. But we also got to pay attention to the clock, because we are winding things down here at Stocks in Translation. But make sure you check out our other episodes of the video podcast on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms. We'll see you next time on Stocks in Translation.